You're now plugged into the Delphi podcast.
Hi, everyone, and welcome to another episode of the Delphi podcast. I'll be guest hosting this today alongside Jan Liberman, who is the managing partner at Delphi Ventures, and I'm José, head of Delphi Labs. So today with us, we have Michael Egorov, one of the DeFi OGs, co-founder of Curve, one of the original DeFi summer protocols that has invented a lot of the primitives that we use today in DeFi. And he's here today to discuss his new invention, which is yield basis. Yield basis has the ambitious vision of eliminating impermanent loss on LPing, which would basically allow you to have a natural yield on Bitcoin at scale. So effectively, the holy grail of like a yield bearing Bitcoin. So really excited to dig into how this works today, how he's taking it to market, and how big this could be. And before we start, full disclosure, Delphi Ventures are investors in yield basis. Maybe Michael, to kick us off, do you want to sort of simply summarize what yield basis is, and then we'll dig into the mechanism and more?
Yeah, let's, as you explained very simply, yield basis is a product on top of Curve crypto pools, and it essentially removes impermanent loss. So you can LP just crypto, single-sided, and turn it into essentially a yield-bearing crypto.
Very cool. Jan, you want to go next on a follow-up of how it works?
Yeah. So would love to maybe dive into how it works, and I think part of that goes into addressing what the problem situation is right now and how you go about solving it.
Yes, absolutely. So I think, yes, this problem is not necessarily well known to those who are new to DeFi, and I would explain it this way. Imagine that you want to earn some money on crypto exchanges, right? And let's say on exchanges between WBTC and USDT, right? So you brought your WBTC and USDT and put into some protocol, whatever that is, be it Curve, be it Uniswap, doesn't matter. And you hope that these funds will just passively sit there and make you some fees. And indeed they do. But it appears that if Bitcoin goes up, let's say Bitcoin goes up by factor of 4, right? For example, everything mooned, and it's just like it actually happened. If Bitcoin went up by a factor of 4, then your deposits in the simplest AMM, let's say Uniswap 2, but I guess in Curve that would be the same kind of behavior in this regard. You would have 2 times the deposits plus the earned fees, right? And if Bitcoin went down by factor of 4, then you would have 2 times less the deposits plus the earned fees. So deposits, they grow and fall proportionally to square root of Bitcoin price over there. Now think about it. What happens if you don't put your funds in AMM? So let's say you held your Bitcoins in your cold wallet, and you held your USD in bank account, and you started with, let's say, with the same 50-50 split, but these funds are doing nothing. If Bitcoin goes up by factor of 4, then your the value of your holdings, if they don't do anything, would go up by factor essentially 2.5. And if Bitcoin goes down by factor of 4, in this case, your funds which are doing nothing would shrink to 62.5% of the original value. So whether Bitcoin goes up or Bitcoin goes down, it appears that if your crypto and US dollars are doing nothing, you actually have more money than if you put them in AMM. So it sounds like trying to earn some fees on market making actually leaves you with less money than if you don't do that, which is strange, but that's what people call impermanent loss, and it is some inherent property of all the AMMs out there. Of course, you can try to get rid of this impermanent loss in certain ways. You can try to hedge it by essentially selling this risk to someone else, but that is usually hard to do in a scalable manner. So this whole situation really limited how much TVL is making crypto liquidity. When I made Curve, I made it actually with as like an AMM to primarily swap between assets of the same denomination, like US dollars to US dollars, ethers to staked ethers, and so on. And because they are the same denomination, they don't really exhibit impermanent loss because they don't really diverge in price. And after all, if you have more US dollars than US dollars, you still have US dollars. So it's not really a problem. But with cryptos, with volatile pairs, it's much more tricky because this like a loss of, well, impermanent loss which you get in the pool is actually significant because crypto prices change significantly and they don't like to come back. And if crypto prices came back to where you started, then of course you would have a profit, only the fees you earned, because actually the prices would, the kind of base price of your AMM would go back to where it was when you started. But crypto prices, for some reason, don't really like to go back in the long term, especially for Bitcoin. So something is really needed to address this problem. And yeah, this is why I came up with yield basis.
Appreciate it. And so just before jumping into yield basis, it'd be, I think, just a brief summary, right? The idea is when you put assets into an AMM, you're effectively buying when price goes down and selling when price goes up. And so that's, if you have a stable coin and a volatile asset, as the price of the volatile asset goes up, you're selling it. And so impermanent loss is basically your underperformance relative to a buy and hold. So these AMM, when people are putting assets into an AMM, it's effectively a strategy where you think price will oscillate, but mean revert, and your idea is just to capitalize on fees. And so you have a lot of these individuals that effectively would like to get some form of yield on their assets, but at the same time, they don't want to then sell that asset as it goes up, right? And so that's kind of the issue with the AMM component, is you are effectively selling when it goes up, but in a world where you don't want to and you want to maintain maximum upside, but at the same time still benefit from this asset being used as liquidity for trading, that's where the product that you're creating comes in, right?
Mm-hmm. Yes, that's a very good description, I think. But anyway, I guess it's probably time to explain how exactly I'm solving that in yield basis. And I think, the idea is this. First of all, we work with curve crypto pools, which, as I said, have impermanent loss similar to impermanent loss of Uniswap 2. And that means that if you put, let's say, Bitcoin denominated and dollar denominated asset, then curve pool will have pricing proportional to square root of Bitcoin price. And what really creates this impermanent loss is the square root function. So this nonlinearity, which we don't like and we want to get rid of. So how to get rid of square root? And obviously, when you want to get rid of square root, you need to probably square it, put it to the power of 2. So we need to make some position out of the pool's liquidity, which actually makes square of the price proportional to square of whatever you put in that sort of position. So, and does this position exist? Apparently, yes, it does exist. And this position is compounding leverage. So not just the normal leverage where you have price proportional to the price essentially changing 2 times faster than the original price just at when the price is close to the current one, but it's changing twice as fast as the price of original asset at all prices. And when you do that, then the price of the position will be proportional to square of the price of the asset which you put in there. So you put liquidity, crypto pool liquidity, which had the price proportional to square root of Bitcoin price, into compounding leverage, leveraging by factor of 2. This compounding leverage would always keep, would essentially borrow against the liquidity and buy more of this liquidity, right? So, or it will deleverage if the price of Bitcoin goes down, so it will sell a little bit of liquidity and repay some of this loan, all to keep loan to value ratio equal to 50% at all times. And when you do that, then your essentially your leverage will always be factor of 2, and it will be auto compounding leverage. So it will deleverage on the way down and leverage more on the way up, essentially like that. Then price of all this position will be proportional to square of the liquidity price, which is proportional to Bitcoin price then. So plus the earned fees. And it sounds like it should work for Uniswap 2 as well, but actually it's not quite doing that. As at least simulations show, if you take Uniswap 2 liquidity and apply compounds and leverage to it, then indeed impermanent loss is disappearing. But in order to keep the LTV ratio constant, you constantly need to buy and sell some of the liquidity. And that is inherently a lossy process. And when you do it all the time, it appears that you're losing something. And this is a permanent loss, it's not impermanent. So it appears that this loss rate appears to be about the same as earnings of Uniswap 2 are. So you would probably, if you leveraged Uniswap 2, you would probably lose money on fighting impermanent loss with about the same speed as this pool would earn money. So you would be left with your position proportional to Bitcoin price, which earns nothing, which is not necessarily interesting, to be honest. So we want some real yield here, which is coming not from incentives, but from the actual fees. And good news is that we are leveraging not Uniswap 2 pools, we are leveraging Curve crypto pools. And Curve crypto pools, they do have concentrated liquidity, which is automatically managed. So in Curve crypto pools, you have liquidity concentrated around a price which is close to current price. And when the price of the asset changes, it tries to follow this price of the asset with concentrated liquidity, but only do that if you have a budget to do it. So it automatically manages concentrated liquidity in such a way that the pool is making some money, but also leaving some money to manage this concentrated liquidity. And it appears that this configuration actually earns more money than Uniswap 2 while having the same impermanent loss. So when we remove impermanent loss from that, we have loss rate pretty much similar to what happens when we remove impermanent loss from Uniswap 2, but we earn money with a faster rate than Uniswap 2. So it appears that the difference is positive, and when we actually simulate that, it appears that indeed that's true. I think probably, well, that's kind of in a nutshell explains it, but it was not very easy to make simulations which actually exactly match the reality, right? So that it was very, very important to do.
Right. So basically, the way you're kind of addressing the impermanent loss issue is you've designed a mechanism that's able to borrow the other side, right? So instead of providing 50-50, you just provide 100% Bitcoin, and then the mechanism borrows the cash component. And so what that means is as price goes up, you're not actually selling your Bitcoin, you're just borrowing more and kind of and making sure you're still 50-50. And so
yes, that's an excellent way to describe it.
Yeah, and I think that's huge, right? That allows people to maintain their quantity of Bitcoin that they started with, and they're just exposed to the price of it. And then on top of that, it can be used for liquidity without actually being sold as it goes up. So I think maybe diving into how the mechanism works, right? So the LP positions use as collateral, and maybe where does that borrowing come from, and how the rebalancing would all work would be great to understand.
Yes, I think maybe one thing to mention, which is not immediately obvious, this other side, which is borrowed, is only matching the dollar side on average. It's not matching it exactly at every single time. So the pool composition fluctuates a little bit around this number. So the dollar part of the pool could a little bit fluctuate around this loan size. And that's apparently important, because apparently if you match it exactly at all times, not necessarily you would get a profit. So it's important that asset has some volatility profile, which is, I would say, returning to some sort of trend line essentially. And if there was zero volatility and asset would just linearly change price, maybe this wouldn't actually work profitably. But anyway, this keeping this leverage, or keeping the loan size which borrows the other side, is made by a special automatic market maker which swaps between LP token and the debt. And that is interfaced as a normal swap. So arbitrage traders can use this swap, and even DEX aggregators can use it. So it just looks like a normal pool to them, but it's not. It's actually the smart contract which keeps the debt size appropriate to essentially cover the expectation value of the dollar part of the pool.
And if you guys ran kind of simulations or
yes.
Using historical returns, what would potential yield profiles here look like?
Right. Yes, that's exactly what we did. And for simulations, I have some methodology which I use since actually late 2019, which I first applied to StableSwap, but then I applied it to crypto pools. And actually with crypto pools, I also managed to make this methodology matching very well real returns without adjustable parameters. Methodology is very simple. You treat everything as arbitrage. So you have some external price feed, It can be from a centralized exchange, or it can be from DEXs. It doesn't actually quite matter, but it has to be quite a high quality data. And you arbitrage your model of a pool with this price feed in such a way that this arbitrage is profitable. So you assume that arbitrage trader buys in one place and sells in another place. And also the arbitrage trader leaves some fee to the exchange. Right, so let's say they arbitrage with Binance, for example, they leave some fee to Binance, or they leave some profit for themselves. And if this round trip is unprofitable, then they are not doing that, and you are not getting any trading volume. For example, if your pool has 0.3% fee, and the price is fluctuating within plus minus 0.1%, no trading volume will obviously happen. And that's what simulator will show, that no trading volume happens if fluctuations are this small, so this high fee will not create any trading volume and any profit. Well, that assumes that all the trades are just arbitrage, and there is absolutely zero uninformed volume, which is not necessarily true, but it is actually extremely close to reality. So it's like a pessimistic assumption, but it's actually a very real assumption. So you kind of have to make an algorithm which works even in this pessimistic assumption, saying that everything is arbitrage. Yeah, so that simulates first crypto pool, and then releverage, which keeps the loan size matching the dollar part of the pool, also with the same arbitrage strategy. We run it on historic data, and actually there is another trick which I figured out to do just kind of more recently. It's the market conditions, they slowly change over the time, and if we apply the same parameters to all the simulations and to all really running pool, then we wouldn't really get good results. So we need to adjust these parameters all the time. So what I'm doing right now is taking, let's say, a year of data, and then based on that data, calculating the optimal parameters such as fee and concentration, and applying it to the following month. So the month which was not included in the data which were used to find these parameters, just so that it matches the real situation when we take historic data and calculate optimal parameters and apply it for the month we didn't yet see, and we repeat that every month, right? So if we do that, then it appears that returns, well, it would be, I would say, in this cycle can range from 10 to 20%, something like that on Bitcoin. And I would say that average since beginning of 2023 till now is, well, it's somewhere between 10 and 20%. But I would say at the bottom of bear market, not much trading volume happens, so you probably would have just few percent APR. But when market is kind of more alive, whether it's market crashing or market booming, or like, well, I would say 80% of the market live, or maybe even more, then over there you have probably more than 10% APR on average.
And from the perspective of LPs, right, the yield and the fees are the top line, and then they have borrowing costs. So is that net of borrowing costs, or is
net,
that?
Yeah. It's of course it's net, the fee APR minus borrowing cost minus the losses which you have on managing your kind of your borrowing exposure.
Right. And from the borrowing side, naturally you want to create the best trading venue, but also from the return perspective, you want to minimize borrowing costs. So can you kind of touch on the mechanism by which the I guess the borrowing capital is sourced and how to make that as low cost as possible?
So what we want to do is we want to use crvUSD allocation, and in exchange, crvDAO would get some allocation of YB tokens. And probably the most efficient is not to just distribute this allocation of YB tokens, but to use it to essentially buy votes for liquidity of crvUSD stablecoin pools. So that would additionally expand the supply sinks of crvUSD and make a liquidity bigger for the crvUSD stable pairs. So it kind of stabilizes crvUSD price, which is important for yield basis to work. But there is another thing which indirectly, I would say, charges a fee here, which is the fee to swap between crvUSD and USDC or USDT, because like in most trading venues, WBTC is traded against USDT or USDC, and if we use crvUSD, then there is some fee, of course, to exchange crvUSD to those stable coins, and this fee would would most likely be at Curve. So that's also what Curve gets. And in exchange, yield basis gets the allocation of crvUSD, which is, I would say, free of normal interest rate, but yield basis would pay in different forms.
Got it. Thank you.
And on the protocol side, you've released new pool types like crvV2 as part of Curve. What was the reason for doing this as kind of a separate protocol? And did you consider sort of just releasing it inside Curve?
Well, in principle, it could work, but usually it's good to have it's good to have a new token for bootstrapping a new protocol. But in addition, I wanted to try something new with token economics, and that's actually what I'm doing here. So I'm doing some new things within the framework of VE tokenomics, but it is also applicable to any token economics where native token is distributed for providing liquidity. And that's actually an interesting one, so I probably can focus on that for a little bit. So just like in Curve, liquidity providers get natural yield, and also they get protocol token. But there is a difference. As a liquidity provider, you need to choose whether you want to earn real yield from fees or you want to earn YB tokens, but you cannot choose both. So either one or the other. Of course, if you chose to earn only YB tokens, then those who chose to earn real yield would get some of your yield, which you chose to not earn, and earn YB tokens instead. But at the same time, this part of LPs who earn YB tokens is smaller than all the LPs, so they probably get actually a higher APR than if YB tokens went for everyone. And this makes it easier to integrate because, for example, lending protocols like Avi don't have to care about YB token distribution. They can just integrate the real yield version of YB liquidity. And there is another interesting consequence of this. Imagine that everyone decided to earn YB tokens, as an example. if everyone chose to earn YB tokens, then no one wants to earn real yield. And of course, YB inflation is maximum then, but where would real yield go if no LPs want to get it? Well, the answer is obvious. They would all go to as admin fees to DAO, which is represented by everyone who locked YB for VEYB. So VEYB would get really many fees in this case. But it could happen a different way. It could happen that we've got, I don't know, many Bitcoin maxes, and Bitcoin maxes want to earn only real yield. They don't really want to touch any shitcoins which are not Bitcoin. Or maybe it's a bear market and nobody really believes in tokens. And anyway, you can imagine that. And then all 100% of people would try to earn real yield. Of course, there is some small admin fee going to the system in this case, but the vast majority of the fees earned by the system would go back to liquidity providers as deposits which increase in value, expressed in terms of Bitcoin, for example. But they all don't want YB token. And if they all don't want YB token, then inflation of YB token should be 0 at that point. So inflation of YB token really depends on whether people choose real yield or whether they choose to earn YB token. And that, I think, should depend on market condition. But how exactly it will behave, I think we will see. But I think it's gonna work as some dynamic system, which is choosing a dynamic equilibrium between how, I don't know, traditional stocks work, for example, when you have dividends going to shareholders, and how Aerodrome works, for example, when inflation is distributed to liquidity providers and all the fees go to the DAO. So maybe neither this nor that is optimal, but maybe the optimum depends on the market conditions. And I think that this sort of design can automatically search for this optimum.
Yeah, I like the design, and I'm curious, like as we're launching this, the kind of current meta is points, and specifically, having a point season where you bootstrap TVL, you don't communicate how many tokens are going out, and people farm it in the hopes that the airdrop is big and the token trades at high FTV, and that's worked pretty well for some protocols that are similar to yield basis in terms of what you want to incentivize, like I guess Athena being the closest one. And in a sense, like the sort of Pendle meta on top of the points creates a dynamic that's somewhat similar to what yield basis has at the protocol level. So I'm curious how you see the points meta and like why you decided to go with this design versus sticking to, I guess, what other people are doing with points.
Well, honestly, I can tell for just as myself, I never farm points. I just don't do it. Maybe I missed out on many point farms, but I just cannot force myself to farm something value of which I don't really know. And I don't know, maybe there are many people who are not like that, but well, I think it's important that everyone is informed what's going on. But it's interesting that you mentioned Pendle, because Pendle could be fairly useful here. The yield which you are making from fees, it's on average pretty high, but it can change over time. It depends on what the market is doing. And I think that's the original purpose of Pendle. Original purpose of Pendle is not to convert imaginary point yield to real yield, but to actually stabilize yield which is variable. And here I think there is a lot of need to stabilize the yield which could be variable, so it can give some peace of mind to different LPs, and that's probably important. But it's it's interesting. So we are not really doing the point route, and we are also not going the route of high FDVs, right? But Pendle is still probably going to play a good role here.
In what sense are you not doing the route of high FDV? Like why?
Well, I mean, it's all about the perception, how users see it. If you are doing very high FDVs, I mean, it's many will question, like, is it a fair valuation? Is it not fair valuation? And like, is it right? What's the risk of getting these tokens, right? And yeah, so it's a totally different game. Maybe I'm a little bit too close to the mindset of DeFi summer 2020, when I remember when Wi-Fi started from a very tiny valuation as a valueless governance token, and then for some reason it was kind of revalued crazily over the course of next couple of weeks. So, but yeah, it's I think that's probably a more interesting one. And after all, point games are well, they worked for some time, but I think people don't like them too much anymore, right?
Interesting. And I'm remembering a point with the design that you have this admin fee that increases as more people stake. What's the reason for that? What are the economic risks, I guess, of everyone staking?
Yeah, so I think one of the reasons is this. It's, well, on one hand we have the dynamic emissions, right? And if you don't make them dynamic, then you have the emissions kind of diverging in a way that you have zero people staking and getting non-zero emissions. And the same thing applies to like real yield, to APRs from fees. If you don't make admin fees dynamic, then imagine a situation when a very small number of people are earning real yield, right? So everyone chooses to earn tokens and almost no one chooses to earn real yield. Then if that happens, then all the liquidity is earning fees, but close to zero LPs are trying to earn these fees. So you have kind of finite number of fees divided by zero, right? Divided by zero people earning it. This is not a great situation. You really don't want something divided by zero. You want kind of like zero divided by zero situation over there. And this is why we need to create some admin fee which goes to 100% when nobody is earning real yield. And the other way to describe it is, like I said, imagine that nobody wants your real yield. So where would this real yield go? The only way it can possibly go in this case is as admin fees. So admin fees have to become 100% if the number of people who are earning it goes to zero, or they go nowhere, right? So and then it's just a matter of which function you put in to how exactly it goes to 200% when people who want to earn it go to zero.
Appreciate it. No, makes sense to not over reward when there's a low stake rate, and then at the same way, in the same vein, reward well when the stake rate is high, and kind of create a balance and reduce concentration of yield to a few people. Was curious how you're thinking about the go-to-market, right? I think that the product itself has a lot of natural appeal, especially at a time when prices are volatile. So the organic yield from trading fees is going to be high. At the same time, high activity and all of that lends itself to a higher borrowing rate, right? So that does kind of offset it. But I think broadly, this is a pretty ideal market for this type of product where people want to maintain their exposure, but also try and earn in any ways on top. And there haven't really been a lot of compelling Bitcoin yield products. I think most of them, you're either trading off some economic upside from Bitcoin, whether it's it's sitting in an AMM, or you're selling calls, which comes with its own risk, or you're farming yield from a new protocol that's launching, and meaning that's not really a sustainable way. This is, I think, from what I've seen, really one of the first sustainable ways of maintaining exposure to Bitcoin and earning an organic yield. So yeah, curious how you're thinking of going this to market in terms of where you want to launch and the early days of everything.
Mm-hmm. Yeah, I think there are really multiple potential users here, and of course there are DeFi native people who want to earn real yield on many things, and there are plenty of people who really trust Bitcoin here. But there are, I would say, there are many funds, many who hold Bitcoin, many miners. In principle, there are institutional investors who hold Bitcoin as well. But for institutionals, I think it's important to think what regulations allow them to do. So I think more like a little, not really little, like medium funds and Bitcoin miners would be a good first target. But we should keep an eye on all these treasury companies as well. So maybe they have some good needs here. But also at some point we definitely should go beyond Bitcoin, and beyond Bitcoin, well, the first obvious choice is Ethereum. So you could earn yield this way on top of staking it, and it's not really small. It's just Bitcoin is probably having the best volatility profile for this, but Ethereum is also not bad. So that's another side of like where to go.
Yeah, and I think what's particularly important is, or one of the things are that you want to maintain this position if you're bullish on the asset because you're not selling on the way up, but also in an environment where you think maybe it's toppy and you're not as bullish on it. This is also better than a strategy than an AMM, because if price comes down in an AMM, you're actually accumulating more of the asset, right? And so here you're kind of, I think the fixed exposure in terms of quantity of ETH or Bitcoin works well in both directions, and is a very unique exposure relative to what is a relatively commoditized exposure in crypto, which is the AMM, where you're buying on the way down and selling on the way up, and so I think this does have broad appeal to in that sense too. And then in terms of like the locations you're going to launch, or what chains or what networks, and how are you thinking about the security of Bitcoin component?
Right. Yeah, I think we first should start with Ethereum, which is the most conservative smart contract chain you can imagine today. And conservative is probably important given that holders of Bitcoin are conservative. But also, of course, it's good to explore other chains. And other chains could be, well, what could they be? They could be, of course, exchange chains like, like taking BNB or Base, for example, right? Or Bitcoin layer 2 is an interesting option. Of course, with the caveat that these layer 2s are mostly operating as essentially multi-sigs today. So maybe that will change over time, and then it will be probably very good. But I think the main objective with Bitcoin L2s would be to check if Bitcoin OGs will trust them more than Ethereum, right? But in general, I think Ethereum is trusted more than any other smart contract chain. Well, and of course there is Solana, but Solana is probably having less trust than Ethereum. It's still it's good to look at, and well, the difficulty is that you need to write in a totally different smart contract language for it. So I think we first test grounds in EVM world, and Ethereum first is probably the most obvious choice.
And on the new chains you're launching on, I remember you talking about there potentially being separate instances of the token. Is that still the
yes,
plan?
that's still the plan. I mean, it could be done differently, but we probably will make it so that YB, which is going to be launched, is the token on Ethereum, which is connected to the system which is running on Ethereum. And if the system is launched on a different chain, then they're going to be a different token, well, like which is doing the same thing as YB token, but on that different chain. So those systems, they would operate like isolated from each other. And the reason is this. One reason is that we don't quite trust bridges as much as the chain itself, and maybe it's better to avoid using bridges, but also it increases the simplicity of the system. If you're not using any cross-chain capabilities, the system is simpler and there are simply less things to break. And I think also this creates very interesting BD opportunities, because like imagine that the system is launched on two competing chains, right? If it was a monolithic system, then like one chain helping the project to grow there kind of helps for the system to grow everywhere else. And they don't necessarily want that, so they probably want only, well, something to grow only for them, and maybe to market only the product which is running on their chain, and they really want to build their own world, and the system is very friendly to this approach.
Yeah, we haven't really seen. Is there an example that you can think of where that worked and was kind of active?
Yes, there is a good ecosystem on Base, I would say, which is well, more or less Base only. There is an ecosystem on BNB chain, which is well, not really present outside BNB chain too much. Like, for example, there is PancakeSwap on BNB chain and Venus for lending, and although they exist on other chains, they are mostly on BNB chain. On Base, it would be probably Aerodrome for trading. And I would say that there are some other chains who try to repeat that. There is Bera, where the whole ecosystem is kind of branded in a little bit bearish terms, just for fun. Well, that's, I guess, for marketing purposes. There is Sonic, which has its, I would say, very own ecosystem, although they do have they do have Curve deployed, right? But they are, I think, helping more the projects which are native to Sonic, and even Arbitrum or like Optimism as well, for example, right? So I remember when Optimism was given in OP incentives, they preferred to give more incentives to projects which are really like native to Optimism, not like projects which come from other chains. So it looks like everyone tries to do that.
Yeah, I see what you mean. And I'm curious, maybe like last question on the on yield basis, then I'd love to ask you some just higher level like DeFi questions. But what part of governance is managed by Curve versus yield basis token? Is it what's the interaction there?
Right.
And what things are voted on by governance?
Right. So a Curve governance would definitely define what are how big are the limits for crvUSD to use by yield basis. That's probably the most important part. And also Curve governance will probably vote on parameters of crypto pools used. And yield basis defines, of course, parameters of the AMM which releverages. It defines which assets are added in yield basis, and also it defines how the crvUSD allocation is split between different markets.
Makes sense. And then on DeFi generally, you spoke about DeFi summer and kind of the rise of Yearn. We remember those days fondly as well. But DeFi has changed a lot since then. In that, I think in DeFi summer, there was really this idea that we were building a new, completely decentralized financial system. Like everything was supposed to be on chain. Like people cared about governance and having actual kind of direct control of governance. And the new sort of, I guess, the DeFi that emerged 5 years later, and the big winners look a lot different, and they made very different trade-offs to optimize for like growth and almost treating it as a business rather than these very decentralized protocols that could spin up by some anonymous dev in their basement and grow to billions of dollars. Like when we look at Athena, right, that's using centralized exchanges and Hyperliquid that was very few validators for a very long time and closed source. These look very different than the original DeFi. How do you think about this new world and whether you want, like, are you changing anything in the way you do things to adapt to it, or are you still kind of an OG DeFi principles believer?
I think I'm still closer to OG DeFi principles, although maybe I'm not sitting in the basement. That's probably the difference. Other than that, I think yes, it's still fairly decentralized governance. With VE tokenomics, it looks like it's working very efficiently to bootstrap. Like when you have one token, one vote without VE, you often get quorums like, I don't know, 3-5%. And on Curve, quorums for votes are typically, I don't know, 50 to 70%, something like that. So it's a big difference. And it just means that VE tokenomics works as as something which organizes the voters together. And also, I don't quite think that this a CDFI approach, that it is the right approach. I think it will still backfire. Maybe not today, but maybe it could happen. Although I'm like still, I would say I'm very bullish on Athena and Hyperliquid, and I totally believe in what they are doing. But I would say even when you do everything right, you may have high risk on the regulatory side at some point. Again, not today. Right now, environment is actually fairly favorable, but it still could be the case. Could be the case down the road.
Yeah. And how do you think about, like, for example, working on these digital asset treasury companies, like the listings, the kind of business side of
Yeah.
building a protocol these days? That in DeFi summer, sort of the founders were somewhat like above this to some extent, or at least the core founders really thought they were of themselves as building decentralized protocols, whereas the modern founder is much more of a is much closer to like a typical startup founder, I would say. How do you think about that as your like, is it different building yield basis? Do you put a different emphasis on like the
Well,
BD side and the integrations versus
I think
initially when you did Curve?
yeah, I think it is probably good if treasury companies get launched, if they would be able to actually put their Bitcoin to work with yield basis rather than hold some raw Bitcoin. That and it does make sense to work with them, but at the same time. I don't think Satoshi runs Bitcoin anyhow differently today.
Makes sense. And I guess what do you see as the biggest next hurdle for you guys as you're building this out?
Well, I think first we need to see how it works in real life. Although I kind of did it so that simulations match reality perfectly, but still running it in production in real sizes is probably different. And what's more important is that everything should be essentially pre-programmed, right? But changing parameters should happen from time to time as well. But anyway, so I think first challenge is to actually have it working in real life. Maybe it's not a challenge, but it's still something to see and something to feel. And next, I think next challenges would be totally BD challenges, like how to grow, right? How to increase number of people, or amount of deposits, amount of TVL in yield basis. So how to make sure that everyone who wants to potentially use it knows about it, that they feel comfortable with it, make sure it's very safe. So that's all of the things we need to care of.
Yeah. And I mean, we often talk about like the killer apps of crypto. I think Bitcoin at this point is definitely one of them. Like the sort of digital asset store of value, digital gold narrative has taken hold. And then I think stable coins and dollars with a yield is definitely another of them. But I think Bitcoin with a yield is a product that has been like kind of almost prophesized in crypto for a while and tried in different ways, but has never really been achieved. What do you think the addressable market is of a Bitcoin with a yield? And do you think, because historically, like Bitcoiners have never really wanted to take their Bitcoin like off chain, like the OG Bitcoiners, or move it from the Bitcoin network. Do you think a sufficiently high yield that feels sustainable, that's provided in this single-sided LP format, could do that, or do you think it requires also some kind of like Bitcoin L2 on top? And I guess what do you see as the addressable market for this? Like, what are your goals, your stretch goals for yield basis over the next few years?
Right. Well, I think the addressable market is not really going to be limited by people who don't want to put their Bitcoin on a different chain. I think it's going to be limited by how yield basis itself affects volatility of Bitcoin, because like it extracts yield from price fluctuations. But obviously, if you do that, then price fluctuations become smaller, and they have less yield. So yield will saturate. It will saturate not at very small numbers, but it will. And my estimates would be that, well, today this saturation point would probably be somewhere between 50 and 100 billion US dollar worth of Bitcoin. But if you think about it, it's still like what, 5% of Bitcoin market cap, right? So not necessarily you really need to take to get to everyone who holds their Bitcoin, and they don't really have to put all their Bitcoins in yield basis, because if they start doing that, the yields will start saturating. And of course, it's still quite a big market, but the limit is, I think the limit is not necessarily people, but the limit is volatility. Well, volatility is still produced by people after all, but actually the limit is not the people who want to hold their Bitcoin in their cold wallet in a very simple form. And maybe it's good if they continue holding some of Bitcoin in that form, right? Well,
Yeah,
those
I
people
think,
who want to.
yeah, for phrasing it as the way you phrase it is really interesting. Basically, that there will be enough of this BTC on chain that it'll actually suppress volatility enough that the fees that these people earn won't be compelling enough to make them do it, and that being the ceiling.
Yeah.
And right, that's a huge sum of money, because we've seen that large BTC sell order, right? The 80,000 it was like 50,000 that got sold in less than 2 days, and we've seen the market absorb that and absorb other sums. So it's a very large number. So using that as the North Star, what you'd imagine being a hurdle ahead of that is likely the size of the lending market for the stables needed to pair that Bitcoin with.
Well,
so curious how you see that element evolving, right, to satisfy a market that large, as large as you're describing for this asset.
Yeah, well, we are not taking funds from like public lending markets. We are using pre-mint of crvUSD, and then the question is how that would scale. So if you are using more crvUSD, in principle, the pool which exchanges between crvUSD and WBTC itself acts as a supply sink for crvUSD which you borrowed, but the amount borrowed is not ideally matching amount of crvUSD in the pool, and you need some liquidity for some sort of supply sink for potentially that difference. And this is why we want to have YB tokens, which are used as a kind of grant, IP kind of IP fee to Curve to be used to incentivize crvUSD liquidity, so that these supply sinks for crvUSD are created. And I think they are those would be sort of equivalent to what you are talking about, but you don't really need the size of lending market to match the TVL. You probably need, I don't know, 10% of the TVL to be absorbable somewhere from time to time.
Yeah, I'm not sure I fully followed that last part, that the 10%.
If you're using a traditional lending market, right? If you put 100K worth of BTC in the protocol, you need 100K worth of USD from somewhere, right? So in a traditional lending market, you need 100K worth of crvUSD and someone should lend it to you. Here we would have some pre-mint of crvUSD, but question is, can you scale this up to infinity? And what do you need to do to scale it up to infinity? And the answer is, if you try to scale it up to infinity, then you price fluctuations of Bitcoin and mechanics of what's happening in your system will not kind of create a price pressure up or down on crvUSD on average, but it will feed into fluctuations of crvUSD, and you need some pools to absorb these fluctuations. These fluctuations would be probably exerting pressure, 10 times smaller than this amount of crvUSD borrowed, but still it would exist. That's what I meant.
Got it. Appreciate the explanation.
And you said, at some point it's capped by, Bitcoin volatility, which makes sense. But what's the size on that must be multi-hundreds of billions of dollars now.
No, it's not multi-hundreds actually.
Okay.
I tried to estimate, and I would say today it's 100 billion.
Interesting.
Yeah, so it's not necessarily as gigantic as you can imagine. It's a little bit smaller than that, but I don't know if more people trade Bitcoin, so who knows.
And 100 billion you calculated to maintain a certain yield?
No, I calculated it this way. I looked at how much is sitting on centralized and decentralized exchanges in order books, and you have certain liquidity density, certain liquidity sitting in plus minus 2% prices, for example, right? So I matched how much would the TVL in yield basis be to approximately match this amount of Bitcoin liquidity sitting in plus minus 2%. Well, it's very rough, but that's essentially, I'm hypothesizing here that yields will start saturating when liquidity in yield basis will start matching the sum of all liquidity in the world within small range of prices.
Okay, makes sense.
But it's not trillions.
Yeah. There's a long way to go.
Yeah.
Anyway.
But actually, if we try it with cryptos, why not try it with gold, right?
Yeah. So you would have some on-chain. Yeah, you could have on-chain versions of anything that's doing this.
I probably wouldn't dare to try it with stocks because they like to change prices instantly. Sometimes, and it's scary. But why not? Why not gold? It's everyone wants to have a brick of gold which grows in size every day.
Yeah, makes sense. And last few questions now, just on DeFi generally, what's the coolest innovation that you've seen maybe in the last cycle, and what's one or a few projects that you're excited about in DeFi? It can also be in crypto generally if you're looking at crypto more broadly.
Yeah. I actually more like DeFi and more look into DeFi, and I think it's pretty fascinating how Pendle started being used. I wouldn't have thought that it gets adopted as much as it is.
It's basically an ICO platform, right? At this point, to some extent.
In a sense, yes. Also, I really liked how Athena grew up. So this is fairly fascinating, and I would have thought that this idea is a little dangerous in a way that sometimes the funding turns not into your favor, but on average it is right, and they manage the like where the funds are very efficiently, and it works. So it's it's not really decentralized, but the concept is working, and that's fascinating. And I pretty much also liked how Hyperliquid grew up. In principle, there is nothing super new over there. Like there were perp dexes before, and plenty of them, but I think it's pretty interesting how they managed to bootstrap community, like having some airdrop which was of some unheard of size. That was a good marketing twist without having VCs, or well, that's what they say. But anyway, it sounded fairly, I would say, fairly brave, and it worked. And yeah, so it's more, I would say, not so much in technology, although technology is very good, but it's not like a super unique technology. But how they do business is very, very, very good. So that was these ones were pretty interesting, and felt somewhat new in different aspects.
Yeah, I agree with all those. It's been impressive to see the growth, especially with Athena, which I guess is the nicest comparable to yield bases in terms of growth strategies.
Right.
Probably a lot of inspiration you guys can take
True.
there, getting integrated everywhere. But yeah, all those you mentioned have been impressive comeback stories this cycle. Michael, really nice to have you on to chat through yield basis. I think the yield basis is still pretty under the radar, despite how exciting the potential market size here is, and obviously your credibility. So hopefully this podcast can help people learn more about how it works and get as excited about it as we are. And yeah, really appreciate you joining. I know you're traveling, so thanks for making the time.
It's great to have you on. Thanks for joining.
Yeah, thank you. Very, very nice chat.
Cheers, guys.